Welcome to Regulatory Ramblings. Our podcast today is brought to you by the University of Hong Kong's RegTech Lab, the HKU SEF FinTech Academy, the Asia Global Institute, the HKU edX Professional Certificate in FinTech, with support from the university's Faculty of Law. Visit us at our website, www.hkufintech.com. I'm your host, Ajay Shandasani. In today's initial Spotlight section, we'll be speaking with Viktoria Soltesz, a tax and payment and banking expert and founder of the PSP Angels Group, as well as the Soltesz Institute, on payment systems and how businesses need to understand banking flows to ensure adequate due diligence on their clients. Following that, we'll be chatting with Miami-based accountants Stanley Foodman about an article he penned for LinkedIn stating that the barriers between DeFi, or decentralized finance, and traditional finance were now effectively over. But first, Viktoria Soltesz is the founder of PSP Angels and the Soltesz Institute. With over 20 years of experience, she runs an accounting and tax consulting firm in Cyprus, supporting complex and global corporate setups. She founded PSP Angels out of a frustration of not having the answers to the most basic online payment questions. She then developed the Soltesz payment framework, which is used by international companies worldwide. She also established the Soltesz Institute, a leading independent certification body for the payment and banking industry. She is an EU certified trainer and has lectured at the University of West London. Viktoria is a well-known speaker at various industry conferences and summits. In addition to being an author, sharing her expertise and advice in the book Moving Money, How Banks Think, which was on the Amazon bestseller list. And she was also awarded the Businesswoman of the Year 2023 award and the Payment Consultant of the Year for 3 consecutive years from 2023 to 2025. And with that, Viktoria, thank you so much for joining us.
Well, thank you so much for having me, AJ.
So tell us, why do businesses need to understand banking flows to do adequate due diligence on their clients?
I think what we are doing is pretty unique in terms of no one really has the grasp of the issue like we do. See, I believe payment and banking today impact customer experience, risk management, technology, product development, data security, compliance, finance, and so much more. And I argue that it should be considered as a standalone function, which is like an essential element of the business strategy, not just a hidden and forgotten part of finance. What I see a lot is that startup companies start to launch an MVP, rushing to go to market, and then they try to find a payment or a banking service provider to work with. Now, what we're advocating for is you need to understand how banks think and how money moves, and then build operation around it. And then you can actually work with safer, cheaper, better providers, because at the end of the day, your success is based on how you are able to move money internationally. How can you collect money from your customers? How quickly you issue your refunds? How healthy is your cash flow? Now, the other problem that we see is that the ones who manage all these payment and banking tasks are just not adequately trained to do so, because a lot of different areas, such as like how payments and banking affect the technology, the integration, the UX, the compliance, and other very essential aspects in an organization are completely absent from accounting or economic courses and MBAs. I mean, I'm an accountant. I was never trained on what is open banking, what is the SWIFT network, how Visa and MasterCard processes payments. So whoever is actually making all those decisions in your company is self-taught. There are not that much of a standards out there in terms of best practices or commonly accepted frameworks. So this is what we are working towards, that everybody could make their informed decisions, and you're not really falling for some fintech salesperson smooth talk. You actually understand how money moves internationally, how banks think, and then you can make your own decisions around your own funds.
Interesting. You mentioned fintech person smooth talk, because I know this is sort of related. I mean, I know that your position, as I understand it, is that blockchain and crypto are not the solution. It's just masking the problem. That I think, as you once described it to me, it's the same players trying to cheat the system. Could you elaborate on that?
Yes, I'm not against crypto. What I'm thinking is that if something is masking money and being used as money, I think it should be regulated as traditional money, because there is a reason why we have different regulations in the world, right? We need to fight against the market manipulation, against the scam. We need to filter out all of those creative businesses and individuals who want to avoid paying taxes. I mean, no one wants to pay taxes unless they are forced to do so, right? So if there is something which looks like money, acts like money, but regulated differently or less than money, that's when problems start. And unfortunately, this is what we have seen in the last couple of years in the crypto sphere, that the idea is good, but the execution somehow is taking advantage of this regulatory loopholes. Now, use crypto. I'm not against crypto, but you do need to understand what are those issues and risks of introducing crypto to your traditional banking rails, because maybe your banks are not that crypto friendly as you would think. And the major value of any business today is the capability of how you can actually execute all of your activities, how you work together with your banks, how can you pay your shareholders, how can you collect money from your clients. So you need to evaluate a lot of benefits, but also downfalls around crypto.
Okay. Now I know you're big on education. I guess what I'm wondering is, what type of education and who needs it? Is it the banking staff? Is it the regulators, policymakers, the general public? Who needs to be educated, and what type of education did you have in mind?
I think the problem today is people who are not trained on certain aspects are making decisions over millions and millions. So let's say that you've got a business.
So the government, basically, the regulators and policy.
They have to get closer to the users, and they have to explain that the banks are not just trying to make your life difficult. There is a reason why we have regulations. So that one part of the equation of the education. But the other part is that, let's say that you've got a business, you want to open a bank account. Who is opening the bank account? Is it the administrator person who just came out of the university, not even knowing what to put down on an application to get better terms and conditions, to get cheaper prices, um, to be allowed to use the wider range of financial product? Or, for example, when you have a fintech company, you hire a new sales floor, you are selling all of these new IBAN accounts or banking services. Who is teaching all these sales stuff? How do they know what's the difference between ACH transfers and QR codes and wallets, right? Unfortunately, today, the information is out there, but it's so scattered around the internet. You just don't know who to believe, who is educating you, because the majority of this information is basically coming from all of those companies who want to sell you something, right? So of course, the education is going to be around use my products and buy services because I'm the best. But you do need to see through all of these noise and make your own decisions. And that's what I'm thinking, that we are really lacking of the relevant education around the importance of payments and banking, around regulation, why banks are asking certain documents, what kind of documents they are going to ask. And with more education, I think we could avoid problems so much easier, and businesses could flourish so much better, just with just really understanding that what are you allowed to do and what not and why.
A corollary to the topic of education in this context is awareness. And I know you've also indicated that there needs to be awareness raised in the general population on how banks think and manage money and how money moves. Uh, the companies need to understand cash flows and banking requirements. Of course, many institutions of higher learning, many universities, many high schools even don't teach young people about payments and banking when they graduate. And then, as you put it, the companies also need to understand cash flows and banking requirements. So there's that gap in knowledge. There's that gap in education. So what are you advocating? Are you advocating a societal-wide campaign to raise awareness that many courses, webinars reach people however you can, TV, radio, paper? I mean, but basically get them to be aware of this and get them to know the basics. Or, I mean, is it that simple, or does everyone have to take a course and study?
Our mission is to set the standards and build an ethical and transparent payment and banking industry where everyone is properly trained and informed, and no one benefits from anyone's lack of knowledge. Like, put it for instance, investment advisors must be licensed because their guidance have serious impact on lives. Like, for example, if they advise you to invest in this stock or that commodities, lives could go ruin. People can scam each other. So we need to have investment advisors who are licensed.
Yet even with the current state of compliance, bankers are saying there's too much compliance. Banking is no longer fun. Most of what I do is compliance. They complain that they have to take a ridiculous number of courses every quarter, and that's tedious and that wastes their time. And that even with this level of in-house education and compliance, there's still mischief and fraud and malfeasance in the financial world. So what's it all for if they're going to figure out creative ways around doing the right?
Exactly. Completely agree with you, because all of these improper advice around investment, but at the same way as payment and banking, can be really damaging for businesses, for individuals. And a lot of businesses are still somehow, I don't know why, but the industry is still working with so called these introducers, payment experts who are actually salespeople reselling the different fintech products. And of course, you follow the money and you realize, what's the real motivation. They are selling you something in order to get commission. So what we are advocating for is just like investment advice, banking and payment should have protections against the bias or unqualified recommendations, all of these salespeople who are masking as experts, because this can be seriously damaging. And this can only be achieved if you have a standardized approach, and if we are all fighting for an ethical and transparent payment and banking industry where there are standards, where there is education, when there is certification, where are commonly accepted practices, benchmarks, frameworks, we talk about it as a standalone industry. So this is what we are advocating for.
I'd like to turn about the issue of fair access. What can be done to make existent payment systems fairer in most parts of the developed and developing world? People often complain about access, and access to payment systems is key because otherwise, it does form a permanent underclass of people are having to enter the gray or the unofficial banking system, and all the risks and vulnerabilities and that exposes them to. But what are your thoughts on the current state of payment systems? That what can be done to improve upon it? What are its successes? I mean, we always say, there's more work to be done, but we see in China that a country that was once developing, people can now pay for things via their phone, and same in India. So uh, it seems like in some ways the developed world has yet to catch up because the 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 systems in the developed world are still very antiquated, whereas in the developing world, they could learn from other people's mistakes and adopt advanced technology right away. Like, for example, India did not have to build all those phone networks. They could immediately leapfrog to digital. What are your thoughts then about technology policy and how that facilitates fairer access to payment systems? I think that's something we also have to look at. It's not just law, it's also a technology question.
Of course, and there's always room for improvement, as you said, everywhere. But thankfully, we see a lot of government-funded initiatives of making payment systems faster, quicker, safer, cheaper globally. Because if people can pay each other in a fast and cheap way, that somehow boosts the economy as well. So this is what we see, for example, in Brazil with the PIX, in Pakistan, the Rust, in India, the UPI, in Europe, we've got the SEPA Instant, which is an initiative that within Europe you can send money basically free immediately to any bank account. And this is now, the European banks are now obliged to join the system. It's not a choice, it's enforced by law. In the US, we see the Fed now. So we see that there are more and more government initiatives of improving these payment systems, which in my opinion are absolutely fantastic. Because oftentimes these emerging markets' success lies in how quickly they can join the international global trade. And if you have just a mobile phone, but you still have the capability, which is supported by the government, so it's not just like an individual, private institution who is who's benefiting all of those on-tap markets, but actually the government is helping the people to pay quicker, safer, easier, and therefore join the global flow of money systems. It's absolutely fantastic. So yes, I think we are heading towards something beautiful. Of course, everything comes with difficulties. So the harmonization of the law, how good is the KYC and AML checks of a certain country for me to accept all of those fast transfers from abroad? Of course, those are the details that we still need to figure out. But overall, I see that there is an initiative, and that's what matters, that the emerging markets are now really catching up thanks to the technology, and joining into the global ecosystem and supporting the global economy. I think it's fantastic.
In the time we've got left, we've covered a few interesting topics. Is there anything you feel we didn't touch upon? Any last remarks you'd like to make for our listeners?
I would highlight that always question everything. Just because it's a bank, no two banks are the same. Just because it's fintech innovation, ask yourself a question, not just the tech part, but the regulatory part as well, fintech. When someone is talking about neobanks, don't just assume things, educate yourself. And mainly if you're a business owner, it is your responsibility to make the relevant, informed decisions over your own money flow. Educate yourself, educate your team, because everything is changing all the time. So good luck for catching up with all of those latest innovations, but it's your responsibility to make sure that you're using the best as of today, which is most suitable for your activities. And don't be shy, just reach out and ask any questions. I'm very happy to bounce ideas with anyone about these payment and banking systems. I'm such a nerd about it.
Viktoria Soltesz, thank you so much for your time.
Thank you so much for the opportunity, and thank you for having me.
We'll have to do it again. And we're back. We're chatting with a longtime contact of mine, Miami-based accountant and tax advisor Stanley Foodman, about an article he penned for LinkedIn entitled Crypto's Compliance Crossover, Are You Ready for Multi-Framework Reporting? In it, he stated, quote, the line between digital assets and traditional finance no longer exists. With CRS 3 now in effect, crypto is fully inside the regulatory perimeter. And with financial institutions, they need to be ready. this isn't just a reporting update, it's a fundamental shift in how compliance must operate across jurisdictions, asset types, and internal systems. In his piece, Stan breaks down the 5 most common gaps in crypto compliance today, where institutions are falling behind, and how to get ahead, as well as what readiness looks like under CRS 3.0. Stan is the founder and CEO of Foodman CPAs and Associates, a longtime resident of Miami. That's where he established the firm over 50 years ago. In fact, the same year in which Richard Nixon resigned as president. With decades of experience in both public and private sectors, Stan specializes in financial crime, risk management, and asset recovery. His background includes serving as an auxiliary special agent with the Florida Department of Law Enforcement and consulting for the U.S. Attorney's Office in civil RICO money laundering cases. He partners with legal teams, financial institutions, and business leaders to proactively identify risks and protect client interests. Stan holds a Master of Science degree in accounting and tax from the University of Miami, and of course, he's a certified public accountant, a certified fraud examiner, a certified anti-money laundering specialist, as well as a member of STEP. He's also a board member of the Financial International Business Association, FIBA, and is a member of the American Institute of CPAs, the FICPA, the Association of Certified Fraud Examiners, the Association of Certified Financial Crime Specialists, as well as STEP. As for his firm, Foodman CPAs and Advisors is a specialized forensic accounting, tax compliance, and regulatory advisory firm serving C-suite executives, banking and financial institutions, legal professionals, businesses, and high net worth individuals. As CEO and founder, Stan leads a team dedicated to solving complex financial challenges, ranging from cross-border tax compliance and forensic investigations to litigation support and regulatory risk management. And with that, I will turn over to the man himself. Stan, thank you so much for joining us.
Thanks for having me.
We can do an episode on the changes you've seen in Miami over the course of your career. I mean, how drug money built Miami, and how you've seen it come up from a sleepy little retirement town to what it is now. But I mean, I want to turn to your law enforcement background. Why that? I mean, why not just stick to the private sector? Well, what was it like being in law enforcement? How does it enhance what you do today? I mean, what benefits do you derive from it to this day, if any?
So the program that I was in, AJ, was a special program that Florida Department of Law Enforcement designed in order to bring talent in-house that it didn't have at that time. It included folks from the IRS. It included practicing attorneys. It included me. It included people that were noted private investigators. And the purpose was to bring a toolkit from each person into FDLE. The reason for doing it was I was at that time the CPA for a nonprofit organization that was called the Pig Bowl, in which various police departments would compete annually in a football game. And what was in the Orange Bowl Stadium of Miami, which is now the stadium for the Miami Marlins, for the Florida Marlins. And so the person running that program for the Miami-Dade Public Safety Department asked me if I'd be interested in joining this new program. And I said, of course, it's interesting. And I was pretty upset with what I was seeing going on around us. We had had a string of murders, and we had a lot of money laundering going on, and a lot of children becoming addicted to cocaine and other drugs. And so I said, sure. I was tired of the corruption.
Was this during the cocaine cowboy era?
Oh, sure. It was in that part of sure. It was in my lifetime. I went in, and that's what I did. And I got a great education there. I had a supervisor, my direct supervisor was a former NSA field agent, which was unusual. Great guy, taught me a lot about how to look at things from his perspective and the perspective of doing these sorts of investigations. But what I want to do is I want to correct one misconception. I never left the private sector. What happened was they asked me to stay in my practice and do this with them on a part-time basis as they needed me, which was every week, sometimes several days a week, to assist them.
Well, you were in demand.
Well, I was in demand. My house assisted with investigations of economic crime of various types, or sometimes violent crime with an economic component. And it's kept me in good stead all these years.
Well, it certainly underscores the fact that a lot of the people in the public sector don't have that knowledge, and that they have a lot to learn from the private sector for sure. But let's turn to a key point in your article, that the opening line, the line between digital assets and traditional finance no longer exists. I mean, why? It's a very punchy, potent statement. I mean, it carries weight. It has heft. Why would you put it like that?
Well, it's because there is a movement on, and it's ongoing for countries, various countries, to create their own cryptocurrencies or digital currencies. And so once that happens, of course, now digital currency at that point would become readily exchangeable for goods and services. And that means that it's going to be treated really no differently than fiat currency in many ways. And so it creates an entire new dynamic for the industries surrounding it, and the banking industry in particular, but also law enforcement and other groups. I know from a conference I was at in Mexico City on international corruption that the IRS in the United States has algorithms that allow it to track a cryptocurrency around the world. The moment it goes into, it comes out of a private wallet and goes online, it's traceable. It's not crypto. It never was, actually. It was always pseudo-anonymous, but it's become, they've gotten very good at tracing it. There have been some interesting recovery cases. And so that's why I believe that. And I see it coming on more and more. I just got back from the International Symposium on Economic Crime in Cambridge, England, and that was a topic of discussion also. So at that, from some very, very prominent and respected people around the world. So it's time is arriving. More and more banks are considering it. I know it's interesting that one of the largest banks in the country, or the largest bank, at one time considered issuing its own crypto, if you will, or digital assets. And we're seeing more and more banks accepting it, not just in the United States, but around the world. But the problem still exists, which is right now it's not readily convertible to goods and services. But it is a subject of a lot of study, and it looks like it's moving in that direction very strongly. I know that the current administration in the United States is a big supporter of it. And the previous administration was also studying how to make it into a into legal tender for the United States of America, which means that it may have a really negative effect on the current Wild West market of crypto in terms of valuations and so on.
It's interesting you say that, because today it was announced here in Hong Kong that they were going to make it easier for banks to hold crypto. So that seems to be the direction things are going in now. In your article, you highlight the key risk areas as being incomplete capture of wallet ownership and sender or receiver data, misaligned AML, KYC, and tax due diligence processes, gaps in cross-border policy coverage, and limited interoperability across compliance tools and departments. We were hearing complaints similar to this pre-crypto, right? So
Yes.
it seems like same problems, different guys.
Prior to me writing this article, and for some time, most banks would not allow the banking of crypto. And that's why these crypto funds and crypto brokerage firms grew up in order to give people a place to deposit their money, or what they called their money, which really wasn't money, but they called it money because it wasn't legal currency, it wasn't legal tender. But in any event, what's happened, so what's happened in the banking industry is that the banks had not been prepared, and although they are coming up to speed, I've been seeing that, but they haven't been prepared for what they need to do to get involved with their KIC and customer due diligence with respect to what we're calling crypto here, or digital asset coverage and KYC as to who owns this stuff, who's the ultimate beneficial owner of entities that own it, and so on and so forth. So, and of course, that means new software, and it also means that this limited interoperability across compliance tools and departments is where is this deals with who's going to be responsible for it. And of course, it's going to end up in the compliance departments, as it always does, but the boards of directors have to be brought up to speed on this, and they need to be trained, so to speak, or have courses or information imparted to the boards concerning what it really is and how it functions and how it's valued. So yes, it's the same old thing, but with some new twists, and they're related to education, existing and non-existing software, how to track it, how to determine who owns it, how to determine who's using it and for what purposes. It's a brave new world with respect to crypto in many ways. And and much like what occurred with FATCA, where banks tried to silo it, it turns out that it should be and is more properly part of the overall compliance picture. Although when there may be specialists in the compliance area of an institution that that specialize in that specific area, so that they can help to educate their fellow employees of the bank and and also to be able to pass on that information as there's a turnover in personnel and so on. That is a constant problem for the financial services industry.
Now, you once recounted to me that you thought crypto was great, it was beneficial, it was a boon, it would aid law enforcement in investigations. You still think that way?
That's absolutely the case. I think that as law enforcement's come up to speed and is coming up to speed, the fact that crypto can be traced across the blockchain is important, because the blockchain is indelible. One of the things that an IRS criminal investigation agent and an FBI agent told me during a short conversation at that same conference in Mexico was that they loved dealing with crypto because they didn't have to find witnesses once they found the blockchain, once they found the ledger, distributed ledger, because it was indelible, couldn't be changed, couldn't be altered, could never disappear. And that was sufficient evidence to do what they needed to do to have bad actors tried and convicted. So yeah, I think it could be a great boon to law enforcement, but I also think it's one of the finest methodologies for maintaining integrity within a system. It's not without these particular algorithms and access and a lot of computing capability, which the average person just doesn't necessarily have, even with today's computers. Crypto becomes it's great for security. It's great for maintaining security if it's used that way. And it's also great for law enforcement and for maintaining the integrity of books and records and for organizational documents and organizational information, simply because once it's recorded, it's indelible. It's not only for financial transactions. Almost anything can be recorded in the blockchain.
Well, here's the thing. Would you envisage a unified blockchain that all banking and financial institutions are part of or privy to, or do you see it as each bank having its own private closed circuit blockchain? Because my sense is the banks want the latter. They want their own, whereas a public ledger, a public blockchain where all banking and financial institutions have to reveal what's on their books would be beneficial. With that, we could avoid another 2008 crisis, because we would see, okay, Bank A, you've got too much risk on your books. Maybe you need to unwind some of those trades. That would be beneficial to society and the economy at large. But my sense is the banks don't want that. They want their own closed circuit blockchain where no one on the outside can look into theirs, but they can derive the cost benefits and savings of the blockchain. And, any monetary savings will, of course, go to the bank's executives. They're probably going to be passed, or the shareholders. They're not going to be passed on to the customers. But I mean, that's the cynical view that some people have. What are your thoughts?
Well, I'm not sure. I'm pretty cynical, but I'm not quite that cynical because the private sector is still the private sector, and banks are part of the private sector. Although they play a dual role, they're also the keepers of the flame, so to speak, for the private sector. So I think that, yes, banks want their own internal systems, but it's interesting. There's a small universe of software available out there. And so banks use a lot of the same software, which allows them to communicate with each other when they need to. It's not that difficult for them to merge. It's not that difficult for them to be bought and sold because the same software that they were using can be acquired in order to achieve the purposes for their mergers. With respect to making it 100% private, they are private entities. I don't have any particular negative feeling about it. I do feel that banks don't always serve the public interest in some respects. They are for profit organizations. They want to make a profit. Do they pass on their savings to their customers? They may, but on the other hand, there's a saying in Spanish, which is Jalisco nunca pierde, which means that Jalisco never loses. So where they pass on cost savings in one place, they may increase cost to customers in another area. Sometimes because it's a new and novel area, and other times just because their overhead requires it. So there's a misunderstanding about the purpose of the banking industry. It is a custodian of the public's trust. At the same time, these are privately owned or publicly traded companies, and they have to answer to their owners and their shareholders without crossing lines and committing crimes. So, or torts for that matter. So they walk a thin line. They're under constant pressure, and I don't particularly feel as cynical as what we were just discussing. My cynicism goes to the uses of crypto as it's been done historically up until now, because I do think that it's been misused in many ways.
And that is, for the better part of the last decade, that is the prism through which people have looked at it, as a means for conducting illicit transactions and the province of online criminals, money launderers, terrorists, child porn types,
it's when government wakes up that these things begin to grab control. Every new technological financial advance becomes the Wild West for a while, and then all of a sudden, government wakes up and says, "Oh." In the meanwhile, it has permitted a lot of wealth transfers that probably ought not to have been permitted because they were done for illicit means. In the United States, what we did is we have several of our government agencies, federal agencies, involved with trying to control it. The most prominent is the IRS, but we also have the SEC, the Securities and Exchange Commission, and the Commodities Exchange Commission, and so on. And what the IRS did is they took the position that crypto is another asset, just like any other asset. So whatever you do with it is a transaction, and whether you exchange it, you use it to buy something, you sell it, whatever is done with it creates a financially reportable transaction. And that's been their approach, and they have taken what we call the soft approach, and now it's become the hard approach. They started with asking a simple question years ago, going back to 2014, and they've gotten more and more emphatic about it, and now we're having crypto prosecutions in the United States. And I think that's and it's starting to happen in Europe with CARF, and the fact that governments there also need revenue, so they're beginning to look at it very closely. And I think that you're right. For at least 10 years, it was like that. It was a Wild West sort of situation. It was a tool for what's known as the dark web, and it was the province of hackers, and people were stealing it, and people were being paid in it for and when they froze people's accounts, and they started to extort them because they could hack into their computers with malware. And yeah, it was a bad situation. It was a very negative situation, but I think it's getting better. My concern now is the amount of money that's come into it from the private sector, not from very wealthy people, but from people who have hopes and dreams of becoming wealthy. And I think when government begins to use it as in the same way as fiat currency, I think that it's going to freeze its value or drop its value for the speculates of crypto. And there are people who disagree with me, and they keep encouraging me, and I keep on drawing back from it because I don't trust it, and I think that it's a rigged casino. That's just been my feeling for a long time.
What, the crypto is a rigged casino?
I think so. At certain levels, yeah. I think that some of the valuations don't really reflect any underlying real value. There's no store of value there of any kind. In some ways, it reminds me of with the ups and downs, it reminds me of the tulip crash in the Netherlands back in, I guess, 14th or 15th, 16th century. So it's where tulips were used, like crypto. You grew tulips and you could buy them and sell them, but of course they died, and so they became ugly after a while. But I think that this has been very similar, and it reminds me of a very slick, effective Ponzi scheme in certain ways, and with some very, very big players in it that are moving the values up and down. And I've been frightened of it, quite frankly, because I don't want to put my hard-earned money into it.
I personally think it's dubious. A lot of people are jumping in on it because of, FOMO, fear of missing out. They're seeing other people getting fabulously wealthy, and they're jumping on the bandwagon, only they're jumping on the bandwagon late in the game. That the people who was talking about crypto in 08, 09? I remember it was Max Kaiser on Russia Today. He was talking about it, and then you could buy it, for less than $1 each Bitcoin, and people are entering the game pretty late, and I too wonder where these valuations coming from. Yes, interest has increased in recent years, but certainly in Asia, Hong Kong, Singapore, I don't see the level of buy-in amongst the older generations. That the attitude is, if I require that level of privacy, I'll just use cash.
Well,
And plus, a lot of older people would prefer that way because they're not all that tech savvy.
well, for me, it's viewing it from the law enforcement hat perspective. I look at it, and I look at what happened with the dark web with crypto, but I also look at it from this perspective. If there's a limited amount of a particular crypto asset, and that asset is being hyped and treated and pushed by people who want to make money from it and have the money to continue and the staying power to do it. And someone who doesn't have that staying power thinks that they're very wealthy now that they have a store of it that's worth, let's say, $10 million, to use a number. And tomorrow that crypto drops because somebody decided to do a large sell-off because it reached the level where they thought they could make a lot of money based upon their original purchase price. That's exactly what's going to happen because that's how it works. It's no different in that respect than any stock market, which is another discussion for another day. But I just have some real negative feelings about it, and that hasn't gone away exactly. But I think that once it's converted to be because it'll then be achieve what it was ostensibly meant to do, which was to take friction out of banking, take friction out of the movement of money, and to do it in a with some sort of anonymity and protection that the blockchain gave it. I mean, really, unless somebody has all of the keys to somebody's wallet, and it's kept off of the web, then it's protected from hacking in those terms. But the moment it goes on the web, it's open to hacking. So it's an issue. It's a security issue for the people that have it, and the brokerage firms that are using it. They're being put into more and more of a reporting situation that they're going to be required to do. CARF is going to require it, and DAC 8 requires it, and just starting next year. And so, I mean, it's a I think it's dangerous, quite frankly, until it becomes fiat currency.
That's a valid point. I mean, now proponents would say we take compliance seriously in the crypto space, that many of our people are former bankers, investment bankers. We're well versed in compliance matters. And then the point is that at some point you're going to want to convert that crypto into fiat currency. So at that point where the off-roads, where the off-ramps merge with the highways of mainstream conventional banking and finance, at that point, all identities are revealed. Everything is disclosed. So the disclosure takes place at that stage, so that you don't need to worry. That's what they would say.
So what they're saying, so what's going on right now is, and I put it, and it's in the article, is that now that the banks are starting to accept it more and more, and they're accepting deposits, the KYC is coming right into play. It's not just a question of converting it. The banks will have their own customer due diligence, including ultimate beneficial ownership where there's entities. They will do their background checks. They'll do their OFAC checks, their EU checks on who these people are that have this crypto and want to bank it. It's going to become very regulated, just like everything else is. Look, when Ayn Rand wrote Atlas Shrugged, she talked about overregulation to a great degree, and she talked about, I'll call it crony capitalism, for want of a better term, and how it could corrupt marketplaces. Well, when there are very, very wealthy people, and I'm talking about multi-billionaires that are heavily invested in crypto, where some of them are, and who have been promoting it as a result because it drives the value, then I begin to, and people tend to look at these multi-billionaires as if they're special, and they've made that money. But on the other hand, that doesn't mean that they're any more reliable necessarily than anybody else. And I think that there's inherent conflicts of interest in pushing values. And I think those conflicts of interest come out when the people that are pushing the values and have the wherewithal to, and the staying power to do so, eventually decide to cash out. And when there's no controls on any of this, and it becomes more like insider trading than anything else, I think it's a danger to the public. And so under our current regulatory system in the United States, I'm talking about, so the rest of the world is a little different. But yeah, crypto is, I don't have some of the negativity I used to have about it. I just understand that it's coming into its own, and that is going to eventually become a form of fiat currency. And by the way, from my perspective, those that are not treated that way as fiat currency will have no choice but to essentially disappear. You know, we trade in currency right now all over the world. I'm talking about the governments and folks. And so it won't be anything any different. And so if the value of a United States digital asset, a coin, is tied to the U.S. dollar, or it's tied in China to local Chinese currency, or the yen in Japan, whatever it is, that's the value it's going to have in that local market. It can be traded, but it's still going to be controlled because it's going to be tethered, as they say, to those things. It'll be allowed to exchange for goods and services, and it'll be treated like fiat currency. In which case, most of the speculation will have to disappear, and values will have to come into line with that, and that's not going to be a pleasant situation for a number of people. And so, as that's timed, and as those things occur, you'll see I think we'll all see changes in the market for crypto and certain coins and other sorts of digital assets. I just don't right now. I just don't see that it's anything other than what it is, which is a speculative uh, asset which has no underlying intrinsic value on its own. They can talk about stable coins or whatever they want, people that are pushing it, but at the end of the day, it's still tethered to a fiat currency. There's no other way to treat it. And in order to use it, it has to be converted to fiat currency to get any actual use out of it. And that's my concern.
Well, certainly that's been the position of the Hong Kong Monetary Authority, our banking regulator and de facto central bank for better part of the last decade, that these are digital commodities and you trade them at your own peril. And they're not
That's right.
they're not to be regarded as currency. And then there's the whole debate of stable coins versus, state minted digital currency, which every unit has its own serial number, like with banknotes. And that, there's that whole divide. I mean, certainly in the US, the crypto bros want stablecoin. They don't want the government issue its own cryptocurrency competing with theirs. And I mean, we had you and I have discussed this shortly after the last election, that there was no shortage of analysis and commentary saying that this was literally the election that crypto either bought or won, because there were a lot of people, and we had Henri Arslanian, former head of PwC's fintech practice in Hong Kong. He's with a crypto hedge fund now in the in Dubai, and he was on the show a couple of months back, and he said, yeah, there are some one issue voters, and that one issue was enough to compel them to vote for Bush over Harris. I'm sorry, to vote for Trump over Harris, and that because he was deemed as being more favorable than the prior administration. He made a bit of a turnaround from his first term, but again, there are one issue voters, and you can see the dangers of people taking a position that Trump was going to win and then voting in that same direction come election day, and it almost becomes a self-fulfilling prophecy. And yeah, I mean, we can't we can't downplay the impact of crypto on the political process, because there's some very wealthy, powerful people in that space.
Well, the United States, we have these political action committees, which allow for, once the money's in the political action committee, that's been put in there by voters,
Yeah.
that they give as much money as they want to the campaign of any specific candidate. So yes, Trump got huge PAC money. So did Biden. So did Biden Harris. Her message wasn't as well accepted. And, there's a lot of misunderstanding about the economy. And the crypto pros, as you said, were happy with seeing Trump because Biden was actively exploring a U.S. crypto fiat currency. And Trump is, of course, not doing that, and he's doing some other things, and he loves crypto because look, I mean, everybody wants to be more comfortable economically than they were yesterday, and whether whether we're in favor of this administration or the prior one or a future one, at the end of the day, and we've discussed this at length. I always say, and I will continue to say, if you want to know what's going on in the world, follow the money. Because human beings are just very susceptible to economic temptation. Just the way it is. Otherwise, large criminal organizations would have trouble existing. So this is nothing new, and it's just human nature. My position at this point is to do as much as we can to help people, not to be a nanny society, if you will, but to try to form some kind of fences around them to help them to negotiate their lives, because it's a very complicated world for all of us, and it's hard, and but people are busy working day and night just to support their families or themselves and their children or their parents or whatever's going on in their lives, and they take a chance on something like crypto. It's no different than jumping into another Ponzi scheme, in my opinion, because it's got the controls of what's going on. It's not the marketplace that's controlling, and it's being controlled by one or a few people who have the ability to make it tank or not tank. And I wouldn't be surprised that when one of these things drops dramatically in value in the marketplace, that all of that the really large people, the bros, as you mentioned, made a decision by themselves behind closed doors in a meeting or on a phone call or some other way to decide to cash in on the increases in values that have occurred. And they don't really care what happens to anybody else, because they're worried about themselves. So yeah, but it is a brave new world that's coming with it if it keeps going the way it's going. I think the Europeans in this case are going to have a big effect on this. I think that um, the situation in the United States, whether we like it or not, whichever side we're on, or maybe we're neutral, has forced Europe into acting in ways that it never did previously. And the European Union, if it can keep its cohesion, is coming up with some great ideas for protecting the banking system and from bad players, or from criminal actors, and that will include crypto.
I want to turn back to what you said in your article about the strategic priorities for compliance readiness. You state,
Sure.
quote, to meet new demands of crypto compliance, institutions must go beyond surface level solutions. A true response to CARF requires structural alignment across policy, data, staffing, and governance. And so some of those priorities you state are integrated policy frameworks, a unified data architecture, enhanced client onboarding and monitoring, staff training and cross-functional collaboration, and cross-border regulatory mapping. I mean, the one thing that leapt out at me was when you say under unified data architecture, breaking down internal silos and creating a centralized data environment. The world's largest banks are still siloed institutions, and that's partly a reflection of the turf wars within those institutions. I don't know how you get around that, because there are a lot of egos involved.
Years ago, I represented a very large privately owned company in another state, and I had to do a turnaround case for it. I had to help it turn itself around because it was being drained by its owner, and creditors were very upset. So I was hired by the creditors, and the owner was removed from the presidency and so forth and taken off the board. And what happened was, we did, I'm going to say we played volleyball. Everybody got cross-trained. It did, every single head of every department became cross-trained, partly because they didn't understand what their siloing of information was doing to the effective running of the company. So what I'm discussing here is breaking down internal silos, not to take away people's turf, if you will, but so that they have a better understanding of how their turf affects everybody else's turf, and therefore the organization's turf overall. When paperwork or when information is not allowed to flow freely through an organization, for whatever the reason, maybe somebody committed a sin of some kind and wants to hide it, but whatever the reason is, it should be harder to hide it, is what I'm trying to say. And I think it's going that way. I'm finding financial institutions are investing are talking about investing much more into training, which is going to help break down those silos not only from one department to another, but internally throughout, and and increase the movement of information from the top so that the tone from the top becomes more pervasive. And if the tone from the top is to run a relatively transparent and clean organization, given that there's a certain amount of privacy that has to be maintained for shareholders' purposes and other reasons, I think that it will just work better. And what's going to have to happen, because crypto is by its nature not transparent or hasn't been, it's going to have to be merged in and become part of an overall transparency push, which, by the way, is being forced by government anyway. The United States AMLA of 2020 made it very, very clear that.
You're referring to the Anti-Money Laundering Act, correct?
Yeah, so 2020. Yeah, it's made it very clear it's created a long arm structure to allow the U.S. banks to get information they could not previously receive. Now, this brings up issues of local regulations and other things outside of the U.S. or between blocks, nation blocks, and other things. But at the end of the day, the idea from my perspective is banks need to serve several masters. Just because of the nature of the industry. One of the things that they have to serve is their shareholders. And if they're a privately held bank, it's different than a publicly held bank as to who they're serving and to what degree they're serving them and how they're going about it. And then there are the regulators and the government. And then, of course, for me, most importantly, are the depositors, because it's their money that's keeping the banks going. It's their money that's used to make loans. It's their money that's used to make money. So you have three masters in general, and those three masters all have to be served. And the only way to do that is to have a freer flow of information.
I'd like to turn to something else you said in your piece when it came to staff training and cross-functional collaboration. Equip your teams to understand crypto regulations and compliance risks, and encourage collaboration between compliance officers, IT, legal, product leads to bridge technical and regulatory knowledge gaps. And then towards the end, you point out that when it comes to compliance leadership in the digital future, you say, quote, the institutions that will thrive in the new era aren't just adding crypto checkboxes to those CRS tools. They're embedding digital assets into their compliance DNA, governance strategy, and infrastructure, end quote. This is the thing, that a lot of the time people are looking for compliance officers, ideally with a background in a crypto firm, but they're willing to accept compliance people in general because they realize there aren't that many people who are both compliance and crypto knowledgeable. Does compliance really differ that much in a crypto context, or is it just a matter of a little bit of remedial learning and recalibration?
Well, I think recalibration, is an important word in what you just said, because it's going to require recalibration. You mentioned that there are very few people who really understand crypto that are coming into the space of compliance, and I think that's true. At FIBA, the organization gives courses on this, and it has people from the major law firms that have made crypto one of their specialties coming in to teach things. But at the end of the day, there is training that has to be done in these banks, these financial institutions, about crypto, not just the crypto compliance officers, but the people that face the public, the people that work in teller positions, every single position in the bank that deals with the public and deals with government needs to become more familiar with crypto and both its benefits and its dangers. And and what it really means. We're using crypto very loosely here, but it really isn't crypto. I've said for years it's pseudo-anonymous, meaning it appears to be anonymous, but it really isn't anonymous if one understands how to follow it. And so, yeah, it's going to require training and integration and retraining and and continuing education of compliance people. And one of the issues in the compliance departments is that in prior years, because of an absence of adequate software to assist them, they've been using the institutions have, of course, hired more and more bodies to perform a function. and put people into that function who aren't necessarily able to fully engage that function because their backgrounds are such that they're not trained to do it when they're hired. And so it requires an effort by that institution to try to bring them up to speed. And because of the ever-changing regulations, that training has to be ongoing. And that's really what we're talking about when we're talking about the educational side and the compliance and how it has to be handled. Part of what we do is we do a lot of training work. We do a lot of training for institutions because we recognize that and organizations like FIBA and possibly ACAMS or ACFCS, et cetera, they also recognize it. I think one of the differences is that none of them, the others are nonprofit, are not nonprofit, they're for-profit organizations, and so they do what they do. But when we get back to things such as training of folks who are going into the industry by the by the universities, colleges, I think that they have a responsibility to give these people enough basic training so that when they enter the industry, they're somewhat familiar with what they're doing, and they don't have to start from scratch in their educational process. But it has to be done nevertheless. There has to be ongoing training throughout the organization and through departments.
That's no easy feat. But when it comes to integrated policy, which is something we talked about earlier, that's a challenge for institutions. Integrated policy frameworks, that's a challenge for institutions even in this region. And you point out that it's important for banks to expand their internal policies to treat crypto assets as part of the same risk landscape as traditional holdings. Is that realistic, though? Because, I mean, I think a compelling argument could still be made that crypto is still, to some degree, an unknown quantity in that sense. And given the huge vacillations in price, in that sense, it's a more risky asset.
It's a very risky asset because of what you just said. And I will tell you that, but as the banks start accepting it and opening accounts, they're going to have to make decisions as to how they're going to allow those accounts to be used. If somebody puts a quantity of crypto into a depository account, which the bank would normally want to use if it was fiat currency as part of its loan base, right? Because it has to keep a reserve requirement. It lends out the rest of the money. Well, what's it going to do with crypto? Because the value of crypto can be so wildly changeable. So they're going to have to figure those dangers into it and what their risk appetite is.
To market daily? Yeah.
Well, you can market to market daily, but what happens when it collapses? And there's loans out there based on that crypto. And then the collectability of those loans becomes at risk.
This is like 2009, the subprime crisis. Even then, I felt that there were places of the U.S. where the properties values just didn't make sense. They didn't match the market realities on the ground. But the banks did not want to write the value of those properties down because then they take a loss on their books.
Well, yeah, and that's occurring right now, by the way, in certain places like where I live, where values have just exploded. And that's partly a function of population shifts and demographic shifts, but it's also a function of gambling and gambling on real estate. You know, one of the Asian nations made a bet on real estate to back its economy, and it's never recovered completely from that crash of its real estate. So, and it's been 20 years at least. So, yeah, it's risky. And the banks have
to Japan?
Yeah, exactly. It's never fully recovered. And it's a wonderful country. I was just there. I spent several weeks there. I loved every moment of it. But in Florida, where I live, real estate values have gone off the cliff. They've become airborne. And in certain areas, we're seeing some pushback and we're seeing some cooling down, but it's also a function of other things because we're also seeing a problem in our market in the United States. Jobs are not being created at the rate that they want to be created at the same time as well, let's put it this way, the hiring isn't going on, even if the jobs are necessary. At the same time as we're busy exporting people out of the United States, deporting them, I should say. So there's all kinds of issues going on. It's a complicated issue, but with respect to the banks, they have to decide what their risk what their risk appetite is. They have to, in the United States, they take a risk-based approach. There are no safe harbors, and no two banks are alike. They use matrices and other things, but at the end of the day, it comes down to they call it hard, old-fashioned police work or detective work to figure out what the risk is on a particular asset. And in the case of crypto, it's a little more public. But when it comes down to using crypto to back loans and other things, I mean, it's really a very iffy asset for the banks. It's not an asset that they can rely on in its current form. If it becomes fiatized and becomes a legal currency, it will change the landscape dramatically. But it will also cause a lot of people to get hurt. And that's going to be unfortunate.
As we wrap up, is there anything you feel we didn't cover? Any closing remarks that you'd like to make?
No, I'm just very happy. I think we covered a lot of ground, and I really appreciate the opportunity. We've been talking about this for a long time, and we've been conversing back and forth over lately WhatsApp, prior to that email, and then over text messaging for I don't know how many years it's been now. It's been a long time, and I'm really very, very happy that you gave me the opportunity to come on your podcast. And I'm very interested in what's going on in Asia, as I think the whole world should be. It's a very dynamic place with a lot of variety and a lot of different points of view and different ways of doing things from country to country. So you're in Hong Kong, which is a very special place. And I'm thrilled to be able to help you with whatever you're doing over there in Hong Kong by appearing on the show. And I thank you very, very much for having me.
Stanley Foodman, thank you so much for your time.
You're welcome, and thank you. Have a nice day.
And to our listeners, thank you all. Until next time.